Hello everyone. Thank you so much for joining us today. I'm so glad that so many of you are able to join this webinar today, which is going to be the first in a series of webinars that we'll be doing. And I guess one of the bright sides of the coronavirus and having to shelter in place is that we're making much better use of this fantastic technology that's out there. So I'm really grateful that we can gather in this way today. So we're doing these webinars to help you stay informed and so that you can see kind of behind the scenes some of the tools and knowledge that I'm using to guide your investments and your financial plans. So in today's webinar, we're going to be addressing what's going on in the markets and put into perspective how this might be affecting your investments. Okay, so today I have a guest speaker, and we wanted to get his perspective on the situation that's happening with coronavirus and what's happening in the markets and the economy, and what we think, how to best prepare for what's happening now and what will be happening in the future. Apollo Lupescu, PhD and Vice President of Dimensional Funds, is joining us today. Dimensional Funds is a company that I partner with because of their 37-year track record of outperformance in their category. They're a low-cost investment solution that I like to use because of their deep knowledge of investing. So let me introduce Dr. Lupescu. He is Vice President at Dimensional Funds, like I said, and which is one of the premier investment managers in the world. In his role, he is responsible for communicating Dimensional's academic foundations and investment beliefs to financial professionals and to individual investors. He is considered at his firm the secretary of explaining stuff because he excels at delivering thought-provoking presentations in clear and understandable ways. Apollo has been with Dimensional for over 16 years and prior to that taught at the University of California. He also had his own consulting firm, has had his own consulting firm. I guess you can clarify that, Apollo. Apollo received his PhD in economics and finance from UC Santa Barbara, and he holds his BA in economics from Michigan State University, where he completed and coached water polo. Me being a swimmer, I appreciate that. So Apollo, why don't you go ahead and turn on your, oh, there you are, great. So today we're going to have a sort of a town hall style webinar in which I have prepared some questions that I'll be asking Apollo. And a lot of these questions are questions that I've been hearing from my clients and from people. And I thought that these are the type of questions that are on the top of people's minds. So Apollo, thank you so much for being here and welcome.
Hi, Meris. Thank you so much for the invitation, and thanks to everyone for taking the time this afternoon to join us. And by the way, I miss swimming too. It's one of the first things that I hope comes back.
Yeah, good. Well, I'm so glad you were able to take the time to join us today with your busy schedule. I'm sure you are online a lot of the time, like many of us are these days.
Right. Yep. It's been a very busy few weeks for all investors around the world.
That's right. And it has been here too. Yeah. So let me start by asking some questions that I think are really at the top of some people's minds. So first of all, as we all know, a significant part of the economy has just hit the pause button. People are not going to restaurants. People are not able to go out and purchase and just have a normal life. And it's an unprecedented times that we have never seen before. In modern times, I should say, and millions of people are now unemployed. We have the highest unemployment. Our employment has spiked up higher than ever. Of course, we know why that is. It's not because of some underlying financial issue, but it is unprecedented. So, Apollo, first of all, if you could explain, are we technically in a recession now, and is it a good idea to be investing when the market and the economy is doing so poorly?
Right. Well, Maris, that's absolutely true, and you look and you're right. It's never happened in my lifetime, and it's the economy that's on pause, and schools. I mean, I have relatively young kids, and they have not gone to school for a while, and there's also the sense of a bit of anxiety just in terms of going out and the health that we all have to deal with. And at the same time, you look out there and there's a bit of a disconnect between the market and the economy. So let me start with your first question. Are we in a recession? In a very technical matter, the recessions are being declared by a group of economists, and they get together, they have some metrics that they look at, and eventually they declare a recession. And the typical, just this is a very rough estimate, whenever you have 2 quarters of a reduction in production in the economy, and we measure the production in the economy using a term called GDP, the gross domestic product, which means that what's the value of all the goods and services that we produce in the economy. And whenever you see there is a drop from one quarter to another, and you have 2 of these consecutive quarters, roughly speaking, that's when people think that we are in a recession. But from a technical perspective, it's actually a group of individuals who decide when we are in a recession. And sometimes it takes them a long time. But I don't think we need to wait for them to tell us. I mean, it's pretty obvious that we're in a major contraction. Not much is being produced, and nobody expects that we're going to return back to normal right away. So are we in a recession? I think that we really don't need this committee to tell us that we all feel, yes, we are in a big economic contraction, whether you want to label a recession or not. That's just a matter of preference. But there's something that you also asked, Meris, that I thought was really important, which is that why should anybody invest in the stock market when the economy is doing so badly? And why is it that, in fact, the stock market has been shooting up so high over the past few weeks when we have all these dire economic news? And I'll start with this broad concept that I think is useful to investors. There is the economy and the stock market. They are related. There's no doubt. They have to do with business. They are related, but they're not exactly the same. And as I thought about this not too long ago, I watched my daughter. I have a 13-year-old daughter, and she was walking in front of me with our dog. We have not quite a puppy, it's a year old now. But as my daughter was walking the dog, I could see that she had a pretty steady pace. Sometimes she would go faster and sometimes slower, and they would go in the same direction. But there are times when the dog would just be all over the place, was in front of her and behind her, and it was just everywhere. And it kind of got me realizing that this is a little bit like the stock market and the economy. The economy is pretty much like the dog walker, which can go faster or slower, but generally has a pretty steady pace, whereas the market is the dog. It's all over the place, but they are related. They're tied together, and they end up eventually in the same spot. It's just the market is a lot noisier. So why is it that even though they're related, they're not the same? When you talk about the economy, you are reflecting on what is the current level of economic activity, what is the unemployment, what are the prices in the economy, and that gives you a snapshot today of what is happening. That is the economy. It's just what's going on at the moment, and it really impacts maybe the paychecks that we get today. Stock market is very different. Stock market is a place where we can all go and buy ownership in companies. You have, in the Seattle area, you have Amazon and Google and all the companies. And Boeing used to be there, now it's in Chicago. But you have all these companies, large and small, that are part of the stock market, and what we can do is buy ownership in them. Now, when we buy ownership into any company, the reason that we pay the money today to get that ownership is because we expect to get paid for years and years down the road by having that piece of ownership. That's just the idea of a business owner, and that's what you get when you buy shares of a company. You get a piece of ownership, and you are entitled to part of the profits that the company gets to make for years and years down the road. So in that respect, the economy is about the paycheck today, whereas the stock market is the paycheck from years and years down the road. I used to, I got as a gift actually when I was in high school, it was a gift from my dad, and the gift was a photo studio lab where I was able to print black and white photos, and it kind of reminded me lately that basically what a film looks like. If you're going to look at if you're going to look at a movie like the old film, I'm not sure that my kids know what it is. That's what the economy is today, is a frame. It's a particular snapshot of what's going on. That's the economy today. The stock market is basically playing the entire movie. It's an entire movie that runs for a very, very long time. So it's not just about what happens today, but what happens next year, the year after, and the year after. And in the stock market, you have to play the entire movie. You can't get stuck onto one snapshot, one frame in that movie. And you might ask, well, how long can this movie play? Well, many companies have been paying investors for over 100 years. And in fact, we know these companies, and if you are an owner in that company, you would have gotten paid for a very, very, very long time. And that's why it's so different, the economy and the stock market, because the stock market plays for a long time. And just out of curiosity, I wanted to know, what was the stock that has paid investors the longest time? And it turns out it's a company out of Pennsylvania called the York Water Company, and they have been paying investors since 1816. That is 40 years after we became independent. So it's a very long-term proposition. And because the market is forward-looking, because it's looking ahead to payments and profits the company makes years down the road, quite often what the market does is price in, it kind of puts in the price today, just what it sees that is likely to happen. And sometimes it sees ahead, even as unemployment goes up, that information is recognized by the market participants, and the time in which they put it in the price is before it actually happens. And a really good example to illustrate what I'm talking about, look at March of 2009. This is a really bad time in the U.S. economic history, because that was a great financial crisis that we had. And in March of 2009, the market hit the bottom, and after that, the economy kept getting worse and worse and worse, and the peak unemployment actually did not happen until October. That's when we had a 10% unemployment rate during the financial crisis. But guess what happened between March and October? The market kept going up and up and up and up, and everybody was asking the same thing. How can the economy do so poorly and yet the market do so well? Well, in reality, the market already had enough information to figure out that the unemployment rate will continue to rise, but then eventually it would start getting better. So what he was putting in the price was this idea that, yes, we'll hit big numbers in unemployment, but then we see light at the end of the tunnel. And in fact, during the worst year of the economic downturn of 2008, 2009, that was 2009, the U.S. market went up 26%. So they are related, but they are not the same, and we have to be careful not to confuse the two of them.
That was a wonderful metaphor. I really liked that, especially the dog and the walker, because they're very much attached but doing different things. That's really helpful. I think everyone is able to really understand what you're talking about there. So, but the one concerning thing is that we could have a second wave, of course, of this virus. How much do you think that is considered?
Yeah, and that's what's interesting about this situation is that when you look at the market, and this is what market participants, this is what investors are trying to figure out, is they're trying to look forward and say, okay, what will the profits be this year, towards the end of the year, next year, and so on. And what's becoming really hard is to have some sort of a visibility into these, because companies are typically giving investors guidance. So when you're an investor call, a company would give you guidance on what they expected their profits to be for the next quarter and the next year. And in fact, because because there's so much uncertainty, not only about the second wave, but also, well, do we have a vaccine? Will there be some sort of a treatment? All these are just simply things that nobody at this point has a clear answer. Anywhere from the president of any country to any investor nobody knows that, because it's just really depending on variables that cannot be controlled right now. What the market's trying to do is take account of all of this, and what we're seeing right now is that there could be a second wave. There could be a vaccine, and the market has a certain expectation that is baked in the prices today. And the expectation of a second wave is certainly priced in. And if the chance of a second wave actually becomes higher, then you'll see the prices going down. If you see the chance of a vaccine, like it was the case 2 days ago, when the market got a hold of the fact that, hey, this vaccine actually might work, and we might have one by the end of the year, well, then the market goes up, because again, it's the expectation about the future. So the market adjusts every single second to this piece of information that was not known a second ago. But what's interesting, Meris, that is important for people to know, when you look at the market right now, whatever the market level might be, is a reflection of not only the pessimists, the people who are saying, boy, this does not look good, we're going to run into a second wave, might as well sell because we haven't reached the bottom. That's certainly part of the market. I would also say that exactly half the market participants disagree, because for every pessimist who sells, there has to be an optimist who buys. So for every seller, there has to be a buyer. For every pessimist, there has to be an optimist. So what the price right now is reflecting is not only the possibility of this second wave, but it's also reflecting the possibility that we might actually have a vaccine and things are going to really look bright from now on. And what happens a second from now with the market is not because of something that we already thought about, but something that's not really known. And that's why it's so counterproductive to try to predict what the market will do, because the market will be driven by news which is unforeseen by definition, and that's what will drive the market going forward. So even if we have a second wave, that is somehow reflected in what you're paying in a value of a company right now.
Yeah, that's right. So another concern that a lot of people are having is that after the financial crisis, the Fed used quantitative easing to pump a lot of money into the economy. So now there's more money coming in from the Fed and government support. Could these actions lead to inflation, number one? And what will the impact be of all this debt on the market and the economy?
Right. So you're absolutely right. Once we got done with the 0809, actually starting in 0809, the government and the Fed responded to the situation, and I think it was the same in 0809. It's exactly the same today. You are presented with a choice. And the choice is, as a government, as a Fed, do you do something about the situation? Do you go ahead and spend some money and take some policies to try to alleviate the situation, or do you not do that? And I think what the economists, looking at data and evidence, what they saw is that the alternative of not spending the money, not having these programs, it's a lot worse. So it's nobody's plan A. But given that we are where we are, what's the better choice? And to me, again, if I was to reflect a bit, it would be a bit like, if the house is on fire, let's put out the fire and let's not worry about getting the carpet wet. We'll deal with that later. But right now, we're in a situation where the money, in fact, had to support the economy. So if you look at the quantitative easing, which is a program that the Fed really pushed a lot of money in the economy, the expectation and the concern that we heard from investors 12 years ago was very, very similar. This money will lead to inflation. And what's interesting is that we did not see inflation for all this time, for all the money that the government spent. We didn't see barely the inflation budge all these years, even with the money that it was spent in the quantitative easing. And there might be multiple explanations. I'll give it from an economist perspective. The one that I always think is really important for people to understand is that the fact that money is being pumped in the economy by itself doesn't necessarily have to lead to inflation. Part of it is the expectations that people have about the future. Part of it is, there are a lot of considerations, but one of the big ones, again, it's pure economics, is this idea that let's take a factory making paper cups. If you have a certain demand for paper cups coming from consumers or companies or the government, and the factory can produce a number of paper cups, even if there's an additional money and more people buy the paper cups, if that factory has capacity, whether it's because it can scale the workforce or technology, whatever the reason might be, if that company can scale production and has the capacity to produce the extra cups, it does not need to raise prices. The issue is when you have a lot of money and the economy is running hot at capacity, and at that point, with all the new orders that come in, it just cannot simply fill them up. So the only way to solve the imbalance between the orders coming in and what the factory can produce, in other words, supply and demand, is to increase prices, and that's when you see inflation. So what we've seen over the past 12 years is that the economy had the capacity to absorb the money without necessarily having to change prices. So if we were to have inflation, in my opinion, the inflation would be in the short run because of imbalances between the demand coming from consumers or companies, the pent-up demand that's been building up, and then factories not being able to produce as much, whether because we had this tariff war or because workers are being kept at home. So to me, that would be the cause. Now, do we expect inflation, to kind of go to the core of your question? Do we expect inflation? Do we expect trouble in terms of repayment of the debt? Turns out there's a very powerful signal that all of us can look at today to get a sense of what investors with billions and billions and billions of dollars think will happen. And they're not telling us in words, they're telling us with their dollars. And that's a key element. When people vote with their dollars, what signal are they sending you? And that place to get the signal is called the yield on a treasury bond. What does it mean? The U.S. government needs to borrow money, and it's saying, okay, I'm going to put out a contract, and if you lend me the money, I will pay you a certain interest rate for a specified period of time, let's just say 10 years, over the 10 years, and at the end of the 10 years, I'll repay your money back. That's what a bond is. So right now, the government needs money, so would like to borrow money, but would like to borrow money at the lowest rate possible. On the other hand, you have lenders. These are individuals, these are businesses, these are institutional investors, insurance companies. They have the money and they like to put it to work by lending it to the government, but they would like to get as big of an interest rate as they can. So you have these two different groups. People with money who want to lend them, people who want to borrow them, and then when they meet, they find a certain interest rate at which both of them are happy, and that is the yield. What do you get if you lend your money? And the yield right now on the 10-year U.S. government bond is less than 1%. So for the next 10 years, all these investors will receive less than 1% for investing their money. Now, why is that yield so important? Three main reasons. Number one, it sends a signal about the potential for inflation. If these investors believe that inflation will creep up and let's say go to 3, 4, 5%, well, none of them would accept less than 1% because you don't even make your inflation back. So inflation is always somehow baked in that interest rate. And the fact is that it's so low, investors believe that these rates, that inflation will stay low for years to come. The second signal is around the ability of the government to repay its debt. And right now, what they're signaling is that we do think that there's, it's very likely. In fact, it's pretty much like there is no premium on, there's no risk premium to kind of say, I want extra because you might not be able to pay back. So again, if that was the case, you would see the interest rate go up, and we're not seeing that at all. And the third is, at these low rates, the percentage of the GDP of this production that we all put together in the economy, in the U.S. economy, the percentage in 2019 that we had to use to pay the interest on this debt, which is called the servicing of the debt. How much do you actually spend the interest on the debt that we have? Because of these very low interest rates, last year was about 1.8% of the GDP, and that percentage is actually, that number is actually lower than what we paid 20 years ago, when we had a lot less debt. So the fact that interest rates are so low is really benefiting us, because it's not creating such a crunch in terms of how much we have to spend to service the debt. All these signals are right now in that yield, and they all kind of point in one direction. With no expectation of inflation, and it's still a safe bet to put. And we've had this tax cut, and it's frankly speaking, I'm not a political guy, but I'm not sure that I love the word cut, because where I live in Los Angeles, it wasn't exactly a cut. I think that some of the states got hit with tax increases. Mine was a tax increase, so I'm already paying a lot more taxes than I did before this tax cut. So I don't know how it is in Washington, or the part of the country that your clients are from, but one of the is we've already had a bit of a tax increase. Now, it's not every state. Some states actually might have gotten a tax break, but by and large, it's possible. And just to give you an idea, folks, right now, the tax rates that we are paying in the U.S., even with this new, whatever I call it, the tax change that happened recently, it is very, very low by historical standards. To give you an idea, in the late 1950s, if you made over, I think, $200,000, your marginal tax rate, meaning like how much you'd have to pay the government for every dollar over 200,000, was 92%. That was the highest tax rate, 92%. So when we're quibbling now about 37, 38, 35, keep that in mind. 200,000 there. If you made 200,000 and $1, that $1 you would have got to keep 8 cents out of it. So, so the tax rates right now are not terribly high relative to historical norm.
Yeah, because of that, I'm encouraging a lot of people to do Roth conversions. So converting money from an IRA to a Roth IRA, paying that taxes on that money now, so that can grow tax-free for future use.
That's a phenomenal reason. I mean, for so many people, having an advisor like you who understands these tax strategies that would help you benefit not only current year but years down the road, I think is huge, because these are not common knowledge about on households who don't deal with taxes like you do every day.
That's right. Yeah, that's one of the things we do when we sit down and talk with our clients. Does it make sense for you? So let's see, we have some more time. I'm going to keep shooting questions at you if you still are able to take some more.
Absolutely, yes.
Okay, good. So let's see, what did I want to cover? So the coronavirus has hit the economy hard in different parts of the world. Is there a perception that the United States is better equipped to handle this economically than other countries? And should investors still consider international stocks versus United States stocks? Or what's your opinion on the world versus the United States coming up?
Right. Well, there are a few things that are so interesting. Is that you're right, Meris. Not everybody in the world is prepared the same way to handle the pandemic. And frankly, again, I don't know. There is a lot of hard data on what countries best prepared. I mean, my personal observation, reading the popular press and The Economist and some papers, is that the U.S. is not exactly the stellar example to the world on how to do it. We might not exactly be Bergamo in Italy, but we're not really as stringent as perhaps Germany or Singapore or some other countries. Partly because of the freedoms that we enjoy, and partly because it's just that it's just a more diverse country that we have. So I'm not exactly sure that the U.S. is much better prepared, and whether it's during the pandemic or after the pandemic. What's important for people to understand is that what you're really buying are not really international stock markets. What you're really buying are companies, and in that respect, if we consider owning Ford and GM, why not think about BMW and Toyota? That's international investing. We have Nestle as well as Kraft. We have Samsungs and Apple. So to me, that's the idea, is that we want to make sure that we understand the company more than the country itself. And some of the products that we hold dear, for example, Budweiser. Budweiser is not traded in the U.S. It's basically traded in Belgium and Brazil. You have 7-Eleven. It's the most famous convenience store chain, and well, that's a Japanese company. So again, you're looking at companies, and in that respect, what would be interesting for your folks to folks to see is how is a world map drawn based on the value of these companies rather than landmass. And what you see is that a world drawn based on value of companies rather than landmass would look like this. You would have 3,000 companies that are part of the stock market in the U.S., and they amount to about 54% of the value of all companies that you can buy and sell. And there are 9,000 plus other companies that are around the world that are also worth considering, absolutely worth considering. So there are a few things to think about as an investor. The first one is that even in this pandemic, and in fact, it's the same case for the past 35 years, the U.S. stock market has never been the best performing stock market. Even through the end of April, the best performing stock markets in the world, and it would be like, I wish I had a poll to kind of ask people, but I can tell you that the best performing countries in the world through the end of April have been China and Denmark. Those are the two best performing stock markets in the world. And Taiwan, right next to China right here. So are we best prepared? Well, what the market's sending you is that these companies are doing pretty well, and the U.S. is not necessarily on top. And in fact, if you look historically and you go back not only this year, but you look over the long time and you ask by decade, how has decade after decade played out, what you see that in the 1970s, if you were to compare the average return of U.S. stocks versus international stocks in orange averaged a lot more in the 1970s than U.S. companies. And, in the 1980s, it was exactly the same. And in the 1990s, we had the technology stocks that shut the lights out. So these U.S. companies did better. But once again, we had a hangover afterwards where international stocks did better, and the U.S. had a negative annualized return for 10 years. And for the past 10 years, once again, the U.S. companies have done well. And to me, as I've kind of pondered this, first of all, it's not obvious that the U.S. is consistently doing better. In fact, if we redraw the line here 10 years ago and ask the question, what should you buy? International stocks did much better. So if we had asked this question 10 years ago, it would have been a very different answer. Now, it was the same if we had asked the question in 2000, should you still buy international stocks? Absolutely not. And we know what happened afterwards. So we got to be careful that the U.S. has not consistently been on top. But the second observation is that I like the seesaw, Meris, because when the U.S. is doing well, great. When the international stocks are doing well, then it's great, because then we have something to cushion the U.S. not doing very well. So in that respect, I think it's absolutely worth it. The one caveat that I would tell investors is that you need to use an advisor to figure out how much money you put into different parts of the world. That's a different question. So, that's something that Meris and the team basically get to decide. And what you find is that, generally speaking, the preponderance, most of the money goes into the U.S. You just have a diversification component to international markets, but it's not the bulk of the money. and Meris can give you more details on exactly how they allocate for each part of the world, because it's not a one size fits all. It's a very personalized decision for each investor.
Yeah, that's why asset allocation and diversification have been so important and will continue to be so important. I am a big fan of leaning a little bit more towards international than the average advisor, just because I think that is really the future. We're going to see more and more, I think, outperformance comparatively than we have in the past 10 years.
So I think about it, Meris, that U.S. companies have become very expensive. Everybody's clamoring over the FANGs, the Facebook, Apple, Amazon, Microsoft, Google. And yet you think about how expensive they are and what's a better value. I mean, what's a better value? International stocks, the price at which you buy these, it's a lot of times tends to be a lot better value. So if you have two houses on the same block and one sells for $1,000 a square foot, the other one for $100 a square foot, well, which one would give you the chance to buy and flip and make more money? And it turns out that the lower cost ones, and that's a lot of times what investors are seeing, that international stocks present opportunity because the prices are lower. So that's kind of what you want to look for, is the opportunity ahead rather than just panic over what happened in the short run.
That's right. And another asset class that we're going to be sort of weighting a little bit more towards in the future is value stocks versus growth stocks. And, as you just mentioned, but growth stocks doing so well over the last 10 years and a great place to be, and outperformance this year as well. What do you think is an opportunity in value and maybe some other places going forward?
Right. So let's just it's a really good question. So let's unpack that question and see how we can think about it. So when you look at the stock market in the U.S., abroad, it's pretty much global. It's the same idea. Let's just say that from a just an intuitive perspective, all the stocks fit in this box, in this square. So all of them fit in there. And the question is, how do you organize them? How do you separate them in groups that have similar characteristics? And the natural way in which people have done it, the intuitive way that's on the media, is based on sectors. You have technology, you have pharmaceutical, transportation. It turns out that when the academics have looked at this, and very rigorously, what they found is that, number one, there is no really good economic intuition on why we think one group ought to do better than the other. And secondly, the data wasn't there. So what they've done is to consider sectors but a secondary consideration. And instead of that, there are two other main dimensions in the market that have being widely acknowledged as the drivers of investor returns. And the first one is, what's the size of the company? And you have these large companies that you see in the Dow Jones or the S&P 500, and these are the large, well-established jumbotron, the companies that we all know and love. But there are also about 2,000 other smaller companies in the U.S. That are not part of the S&P, but they still trade. You folks in Seattle have Jones Soda, and there's a Coca-Cola, which is a larger counterpart. There's a McDonald's and there's a Shake Shack. So there's, you have Vail Resorts. There's a small company. GNC Nutrition, a small company. You have Dave & Buster's, Buffalo Wild Wings, whatever. You kind of get the sense that there are all these companies, some you know, some you don't, that are part of the small company universe. And they do have a different risk-return profile than large companies, but they also have a much greater growth opportunity. I can see Jones Soda doubling in size, relative, and it's going to be a lot harder for Coca-Cola to double in size. So what you've seen is, over the long run, is there is a difference in the growth pattern for investors. And there's this book that it's been published for decades called The Matrix Book. It's a big book of numbers, the encyclopedia of numbers. And it's so instructive to see what the growth of a dollar would have been over the long run. My dad is born in 1926. If his parents had put $1 in the S&P, the large company stocks, in his lifetime, he by the time he turned 92, he's 93 today, that $1 would have turned into about $7,000. Really nice growth in the long run. Now, if the grandparents would have put, my grandparents, his parents would have put the same dollar over the same time frame in small companies, it would have grown to about $27,000. So significantly more in small. Again, part of it is risk, part of it is growth opportunity, but you do see there is a different risk return profile. And then in the 1980s, the question became, what about all the large and small? Are they the same? And what we just mentioned a second ago, the price at which you buy a company matters. And the low price companies, meaning how much do you pay to buy dividends or earnings or book value, matters. And the companies that have a low price, you can buy them at a lower price relative to the more expensive counterparts. Well, those low price companies are called value stocks, and historically they have outperformed the more expensive counterparts called growth. So knowing that small beats large and value beats growth, obviously the one part of the market that ought to give investors the biggest bang for the buck is small and value. And if you had put the same dollar to work over the same time period in small value, it would have grown to about $72,000, so significantly more. So what the system that Meris is talking about is one in which you buy the entire asset class, and then the more you choose to emphasize small companies or value stocks, the more you give you a chance to earn a higher expected return relative to just buying what we consider to be the market, as in the S&P, these large company stocks. And that's the system. Now, when you see these numbers, you're tempted to say, well, why not put all the money in small value? What's the catch? How come more people don't do it? I don't have 92 years. And all of this is really important to understand, that this is a very institutional way of investing. It's a very rigorous, data-driven. And the same as anything else in our life, it's not about certainty and guarantees. It is much more about investors understanding what to expect when they get into this. Made me think that I used to smoke and not be very healthy. And years ago, I quit smoking and I started eating healthy and working out every once in a while. Is that a guarantee that I'll have a longer lasting, healthier life, particularly in the age of Corona? Not at all. But it improves the odds. It's all about managing the odds. Everything we do is trying to manage the odds. So I'd like you to think of this again in a matter of odds. So when I'm talking about odds is this. If you look on, not on a monthly basis or quarterly, but on an annual basis, whether it's value or growth is roughly the similar. You ask the question, how often do I see outperformance from small or value? And what you see is that roughly 60% of the time in any given year, you see that indeed, yes, that will happen. But 40% of the time, or 4 in 10 years, it won't be there. And that's not trivial. It's a whole year has gone by, and you go to Meris and say, Meris, that bull guy said that small should outperform, and he hasn't. It's been a whole year. Well, the reality is that 40% of the time it doesn't happen. Now, let's say you give it time, and now you go to 5 years, and even if you give it 5 years, it's not going to be a slam dunk. It's going to be 2 and 3 years, 2 and 3 periods, actually, 67% of the time. Once again, you would see that there is outperformance, but then 1 in 3 periods, it won't be there. And there are two things that I would tell you. The first one, it's a question. If you saw these odds, 67% of the time small outperforms, 67% of the time value outperforms, which part of the market would you like to emphasize? You tell me. Because it's quite possible is that we're going through, like we're going right now, that we might hit the 1/3. But if you saw these odds, which part of the market would you like to emphasize? And secondly, because 1 in 3 periods it won't be there, what it might be interesting to do is not put all the money in small and value, but do have some large, do have some growth in case we go through something like this. And one way to think about it is if you have an ice cube tray and it's leveled, every ice cube has the right amount of water. And what we're saying is, take that ice cube, tilt it a bit, take some money from large expensive stocks, drop it down towards small and value, but don't do this. And that's what, again, it's part of the art and the science that Meris does in allocating your portfolios, is deciding not only how much money do we put in international versus US, but within the US and international, how do we tilt, how much do we put towards large, small value growth? And it's a very personalized decision, and they put a lot of work into figuring that one out.
That's right. That's exactly right. And we are tilting in that direction going forward. I think that the long-term possibilities for that look really positive. Okay, so I'm going to just ask one last question. question from my side, sort of overall. People are going to see a lot of bad news coming in that when they're looking at the news, and they're going to see unemployment. Of course, the news likes to tell us the worst case scenarios and the worst of what's going on, and less of the positives and the bright spots. And they're going to see a lot of bad news coming in over the next few months of the sort of the outcome of what's happened because of this. But given all that, and people being really worried, what do you think that investors should do? So what should they actually be doing today, next month, going forward, especially if they're approaching retirement, and kind of planning for a retirement in the next few years, or in retirement?
Right. So that's a really important. Like, what can you do? I would discourage. I mean, the first thing that I would tell people is that the last few weeks I've noticed that emotions have been playing a bigger role of people's investment decisions who don't work with an advisor, and you see people thinking about selling even though they realize they might not be smart. I don't even know when to get back in. So there are some emotions, and I would caution against making investment decisions that are clouded with emotion. Talk to an advisor, because there are other ways that you can mitigate market downturns, and I'll give you the probably what I think to be one of the more effective ways to do it. And it's such an important piece that really starts with understanding the nature of the stock market. That when you look at the stock market historically, it has given investors a very nice growth pattern, a growth return. It's been about 9 to 10% per year on average growth in the U.S. stock market. So that's been the really solid. Real estate has been about 6-7%. So it's a good return that you get in the market. But that is the average over the long run. And what is so important for everybody to know over the next for anytime you invest in the market, is that average is just masking a huge degree of choppiness, that from year to year, this is what the market returns look like. 3 and 4 years you make money, 1 in 4 you lose. But I'm not aware that the market has ever returned the actual average. It's just all over the place, and it's a roller coaster ride. That's pretty much what it is. It's the same with a roller coaster. Your stomach might be turning, but you're better off staying in your seat than trying to jump out in the middle of the ride, because that's when people get hurt. And it's a very rewarding ride, and you just saw it. It's $1 turned into $7,000. But to Meris's point, sometimes you don't have enough time to withstand this choppiness. Sometimes you just don't have the stomach for that. So what do? Well, it turns out that bonds, the one that we talked about earlier, are really a phenomenal place to start in terms of balancing the choppiness of the market. So if you had given the government the money, not for 10 years, let's say you give it for 30 days, you get it back plus interest. These are called the 30-day treasury bills. Over the past 90 years, there has never been a calendar year when you would have lost money. Very little fluctuation in value, never lose money. Here's something that can balance what is going on in the stock market. So if you need some stability, getting close to retirement, one of the things that you might want to consider is talk to the advisor and understand that bonds, in a way, can give you some stability. The other really good news about these bonds is that, let's say these 30-day treasury bonds, they have paid investors just a little bit above inflation. Long-term inflation is about 3%, and this paid a little bit more than that. Inflation is close to zero today, and so are the interest rates. But the idea is that the reason that people could use bonds is that stability. Here's an investment that has never lost money in any calendar year, but there's a trade-off. And that trade-off is significant. You don't make 9-10%, you make 3-4%. And in fact, to see how significant it could be, let's just compare apples to apples. If a dollar grows to 7,000 at 9-10%, put a number in your head. What would the growth be at 3-4%? And what you see is that when you study the numbers, what you find is the same dollar over the same time frame in treasury bills would have grown to a whopping $21. and it's not missing any zeros. It's $21. So it is a significant difference, a significant trade-off between stability and growth. So then how do you know how much to put in stocks and bonds? Well, that's where it's another huge role for the advisor, because what you need is some sort of a financial plan where somebody sits down and figures out, when do you need the money? How much money do you need? Do you have a pension or not? That matters. What's your risk capacity? All of this, when you put it together and all of these pieces of information come together in the financial plan, then an advisor can figure out exactly what is the right balance between stability and growth. And the plan would try to do it in a way that it just balances the trade-offs and tries to get you from point A to point B of your financial life with the least amount of risk, because that's the main idea. We want to make money, but we want to also be respectful of risk. And that's what the financial plan is trying to do. And again, there's not a one-size-fits-all. You really need to sit down with Meris and figure out, first of all, if you have a financial plan, what's the right balance? And if you don't have a financial plan, it's a good idea to at least sit down and figure out what you're trying to accomplish with your money. And in terms of finishing off the answer, what should you be doing over the next 1, 3, 5? Is really try to maintain this balance based on what's optimal for you. And at times when the market drops, and let's say the bonds go up, at times when that happens, maybe what you want to do is carefully think about buying back stocks so you can realign the portfolio, and that is called rebalancing. So quite a lot of advisors, they pay attention to, and Meris can speak to that, they pay attention, and if there's a right time, they might consider reallocation between stocks and bonds, and maintaining that proper balance is hugely important to investors.
That's exactly right. Thank you, Apollo. And yeah, that we actually just did implement a couple of rebalances during this turbulent, though, and we had a big drawdown, and then again at the end of the quarter, beginning of the quarter, so that we could take advantage of shifting a little bit more towards stocks for a lot of my clients. And each of my clients out there, you have a unique situation, and we do have a particular portfolio that is set up just for you and just for your plan to make sure that we are getting you from point A to point B as safely and as successfully as possible. And so if you are my current client, you actually know that, and you know that we have sat down and created a good plan to get you where you need to be during this time and all the way through your future. And it's really important. And sometimes it's good to sit down. At times like this, it's good to sit down and review that plan. So if you haven't seen me for a little while, I do encourage you to get a meeting. And we can, as we did today, which is so wonderful, meeting by Zoom or any other of these technologies is available to you, and I can help walk you through that if you haven't done it before. But I've been having a lot of these Zoom meetings with my clients, and it's going really well. It's nice to be able to do this from the comfort of your own home and not have to drive anywhere. But updating your plan is really important, often to make sure that you're staying on track. And I'm looking at the investments every day, and I really appreciate Apollo having a partner like you and Dimensional Funds to help keep me informed. You got a lot of information from Dimensional Funds and put together portfolios that lean on Dimensional Funds because of their expertise. For some of the portfolios when it makes sense. Not everyone does it make sense to use that tool, but it's a great tool. So thank you so much for Apollo for all of your time and for your expertise. And I don't think that I did receive any questions. So it looks like hopefully we covered everything that people were really concerned about and are thinking about and talking about. But if questions come in later on, if you want to email me or call, I'm very much available, and I can get those questions to Apollo as well. And I'm sure you would be happy to answer those questions for me for my clients, if there's any that are directed directly at Apollo. So again, thank you, Apollo. I really appreciate you being here today.
Thank you so much for the invitation, for the partnership, and the trust you place in Dimensional. And thanks to everybody for taking the time this afternoon.
Great. Okay. Thank you so much. Couple more things. So if you are not, oh, whoops, looks like we did have a question that just came in. Let me see what that is. Oh, so so this came in a little bit late. Tom Boynes, thanks for the question. You're saying that taking advantage of the choppiness of the market, we should allocate 20% of our portfolio to day trading or our favorite stocks. I think that was more of a joke. Excuse me. But if you're still here, if you want to answer that question, I'm knowing Tom Boynes, he does a little bit of day trading, but not too much. Do you want to just kind of give us perspective on the day trading and during choppiness? Oh, I can't hear you. I think you might.
Whether day trading, whether it's stocks or options or oil contracts, whatever you day trade. My suggestion for people interested in doing that is that I find it that it's interesting. It's absolutely, so many people find it interesting. It's a fascinating thing to learn. You stimulate the brain muscle. So in that respect, it's absolutely something interesting that if it captures your imagination, if it interests you, I would pursue everybody to just go more. And the caution that I would give folks is that I would do it, and my brother-in-law actually is one of those folks. I would caution you to do it a bit with like a sandbox type of money, and what I mean by that is that it's something that it's stimulating, and you got to be careful not to overdo it, because the reality is that every person on this call is, and not no disrespect, you are a bit at disadvantage when you go and place a trade in the market, because the market participants have vast resources to get information that is just costs money, and most retail investors don't do it. So when you go in the market, you are competing with some professional investor. There's a team of MBAs and PhDs crunching numbers, paying for data, and it's not always a fair playing field, to be honest. And if you go in and trying to say, I'm going to compete with these folks, you have to ask yourself, what is my competitive advantage? What would make me outsmart these folks? And quite often what you find is that the vast majority of trades are placed by these highly sophisticated professional investors. And if you go and you compete with them, you should ask yourself, what do I know that they don't? Or even better, what do they know that I don't? Because what I found when I did this years ago myself, is that the information that they have is just vastly superior than any one of us can, because they pay for it. Give you an example. Years ago, you find out that if anybody is interested in trading Walmart, there are companies who would sell you data because they launched some mini satellites into space, and they snap pictures of Walmart parking lots and count the number of cars, so they get a sense from quarter to quarter how the sales are going based on the number of cars. They have detectives snapping pictures of people's shopping carts to see what the value of their purchases are. All that is public information. Right now, there are people paying a lot of money to buy data from Apple and Google on how many requests are in Apple Maps or Google Maps, so they get a sense of how the recovery is going. All of that is taking place. And if you go in there and you try to think, I have a good idea where I think this is going to go, again, remind yourself that you're competing with folks with really crazy resources because they have the scale, and that's their primary line of business. So do it because it's interesting, it's fun, but do it with a more limited amount of money, and do it for the right reasons, which is that it's fun, it's exciting, entertaining, and to some people it tickles the ego. I've been successful in everything else I do. Why can I be successful in this as well? Absolutely. Just be careful, because if that's not your primary line of expertise, you might not have a competitive advantage.
Great. Okay. There is another question that came in that I hope we kind of answered in the beginning, but I think it'd be worth going over again. Amy asked if she did miss the beginning of this, but she said, have we already missed the sale opportunity in this market? And do we expect more of a V curve recovery, a U curve recovery, or a W curve or W recovery?
So let me start with the first question. Have we missed the boat? No, not at all. Because what you hear on the news is the market's gone up, the market's doing this and that. Okay, you got to put a perspective. market is represented on the news by a group of stocks that are either called the Dow Jones. These are 30 companies out of 3,000 in the U.S. economy, in the U.S. stock market. So you got these 30 companies out of 3,000, which is the Dow Jones, or a broader measure, which is the S&P 500, which is 500 of the largest companies, which obviously the S&P is a broader measure than the Dow. Dow doesn't even include Amazon. So when you look at the S&P, what you're getting is a measure of how these 500 companies are doing. But what's interesting about the S&P 500 is not a simple average of all the companies. It really puts a lot bigger weight. It emphasizes a lot more the larger companies. So when you look right now in the S&P 500, the performance of the S&P 500 is driven by 5 or 6 stocks: Apple, Facebook, Amazon, Microsoft, Google, Alphabet. Those are companies amount for about 20% of the value of these of the what we consider to be the market. And these companies have done really well. So you think, wow, the market's doing well. Well, that's not the case. Energy stocks, for example, they're only amount for about 3%, but they have been hammered by what's happened lately. Financial stocks hammered, airlines hammered. It's just that their value is not as great. So right now, if you look at year to date, you also have these small company stocks, which are more vulnerable, and they're still down about 20% for the year. So you have not missed anything, because the market is just it's overemphasizing in a way these 5 stocks, and they have done well. But you have to remember there are a lot more stocks that have not actually recovered. So no, you have not missed that the boat on that. Okay. And I know there was a second part of the question that I remember.
If it's a VU or W-shaped recovery.
Oh, so that reflects on, a V-shaped recovery means that we really went down fast, and then from there we actually have a very quick recovery to get back to where we were, and that's the shape of the V. And another shape is that it goes down, up very quickly, then down again, and that's the W. The one that most people, at least out there among the economists, is something that resembles the Nike logo, which is the swoosh. So like it's gone down, but the recovery won't be like as steep as the V. It will still be a recovery, but then it might take longer. And at this point, I have to emphasize the same thing, is that it's anybody's guess, because so much of this recovery hinges on something that we don't have a good model as investors. Whether the vaccine is coming out or not, whether people will respect the social distancing and actually wear masks, is going to make a huge difference. So all these things that we don't really have a good understanding out there yet. Not even how many people are not symptomatic and they might be passing out the disease. We don't know that yet. So it's hard to tell the recovery. But generally speaking, what most economists would agree is that it will take 4 to 6 quarters from now for the economy to go back to where it was at the end of the year. And that's just a general sort of average estimate among economists, 4 to 6 quarters to go back to where we were. Mm-hmm. If that's lower, or if that's slower or faster, it just depends on things that might come out that might surprise us all.
That's right. And that goes back to your financial plan and the right risk tolerance for you, and making sure, all of my clients were in the correct risk tolerance, and, making sure that we could handle any market scenario going into this economy. So it's about holding on. The stocks are long-term. They're looking forward. They're for making money over the long term. And then the bond portion is anything that people are going to need now. Also adding some alternatives, a little bit of tactical money management, a little bit of gold in the portfolios often, just to balance all that out. So that, again, is going back to being the right portfolio for you and for your long-term goals and long-term plans. Yeah, that's right. Okay, thank you again, Apollo. And I appreciate you being here. Thank you for all of you for being here. We went a little bit over time. Hopefully I didn't take too much time out of your days. I really appreciated you coming and spending the time with me today, and Apollo, and I hope that you found this informative. And if you are not my client, I would love to meet you, and I welcome you to come in and give me a call, and I would love to give you a second opinion on your portfolio and give you an actionable financial plan, making sure you have a financial plan that you can use, that you can stick to, and is really working for you. So feel free to reach out to me, and an initial appointment is free to you, and love to. Actually, we're not going to be sitting down. We'll be doing this virtually, but that's easy for us to do. And if you have friends that might need a second opinion about their portfolios and their plans, please go ahead and send them my way. I would love to meet them and see if I can be helpful. We do have another webinar that's coming up on June 30th about the Secure Act and how that is affecting your retirement plans, your IRAs, beneficiary designations, and things like that. A lot of big changes came up in the tax structure. So really important for all of my clients to know about that. So that'll be happening June 30th, and I believe we'll be scheduling some more in between that time. But again, I am here. I'm at the office. Donna Lynn is working from home, and so give us either of us a call to schedule and call and stay in touch, because we are here and really excited to see you and to speak with you virtually. And I hope you are all staying very safe and you're staying well and sane. And make sure you get out to nature and enjoy the outdoors while you can, and be kind to each other and hug your loved ones. All right, take care, and I look forward to seeing you soon.